That, of course, has been in line with estimates, and a couple of other announcements like the ADR, etc. as well, which will lead to some bit of dilution, because the board has now established or okayed the establishing of a sponsored ADR program for up to 10% of the equity. Okay, within seconds from now, Keki Mistry, MD and CEO at HDFC, will be highlighting the quarter, and we're going to cut across to that address of his and try and figure out what the nitty-gritties of the quarter are like. I think we can cut across.
So we just finished the board meeting a few minutes ago for approval of the results for the 6 months ended September 2015. And in addition to the financial results, we've also got 2 approvals from the board. One is to come out with a $750 million dollar-denominated bond in the overseas market. So this is an in-principle approval we've got from the board. The exact details of how to go about, when to do all that, we will take over the next few months. The other approval we have got is to come out with a level 1 ADR, which does not involve the issue of fresh capital. So there is no new fresh capital that gets issued, but it's just a conversion of existing shares into ADR. So it creates a larger platform of people who can buy the shares, buy the ADRs. So apart from these 2 resolutions, we had the financial results. If you look at the financial results, the total loan book outstanding on 30th of September, and this is loans outstanding in the balance sheet after removing the loans which were sold during this last 12 months, it amounted to 2,37,991 crores of rupees, which compares to 2,12,344 crores in the previous year, giving an increase of 12%. But this loan book has been considered after removing, obviously after reducing, the loans which have been sold in the last 12 months. And in the course of the last 12 months, we have sold loans aggregating in all to 12,969 crores of rupees. So if we add back this 12,969 crores, then the growth in the loan book would have gone up from 12% to 18%. The growth has largely been on individual loans, retail loans, which is loans given to middle-income, largely salaried employees looking to buy a house for their own use, for their own need. And if you look at the individual component and we add back the loans sold in the last 12 months, then the growth in the loan book for individuals is 23%. So individual book went up by 23%, non-individual loan book did not increase, the growth was only 8%, and therefore the overall growth after adding back loans sold is 18%. On 30th of September, we have a total outstanding loans of 29,125 crores of rupees, which have been sold by us and on which we get a weighted average return of 1.22%. We also earn income on loans which have been sold by us. So when we sell a loan, we don't book profits upfront, the way you would do it under IFRS or the way you would do it under US GAAP. The difference between the interest rate at which the loan is sold and the interest rate that is payable by the customer, that difference is reflected through the profit and loss account on a yearly basis. So every year we earn income on those loans. So the outstanding loans in this regard amounted to 29,125 crores. Now, net interest income, there are various ways in which net interest income is calculated. Different people calculate it different ways, so I don't want to get into the different methods. But if we were to include dividend within the net interest income, then in the quarter, the net interest income figure was 2,501 crores, which compares to 2,059 crores, which gives an increase of 21%. But that growth has come about because of the fact that in the quarter we have received dividend from HDFC Bank. If you were to look at a 6-month period, then in the course of the 6 months, where everything gets even, including the dividend, then the total net interest income, including dividend, amounted to 4,673 crores of rupees, which represents an increase of 12% over 4,175 crores in the previous year. Spread, which is the difference between lending rate and borrowing rate, if you compare it to September of last year, has gone up by 3 basis points. It was 2.29% in September last year. It now stands at 2.32%. But 2.32%, incidentally, is exactly the level of spreads that were there on 31st of March. On 30th of June, spreads were 2.31%, and on 30th of September, spreads are 2.32%, so broadly in that category. So while spreads have remained the same, if we were to look at the breakdown of spreads between the individual business and the non-individual business, individual spreads at the end of the quarter stood at 1.97% and non-individual spreads stood at 3.1%, giving us overall aggregate spreads of 2.32%. Now, net interest margin for this period stood at 3.95%, which compares to roughly the same number which we had in March. But in September last year, net interest margin was slightly higher at around 4%. So there's been a marginal decline in the net interest margin, which has been caused despite the fact that spreads have actually widened compared to the previous year. And the reason for that is the interest rates that are prevalent in the system. So if you look at our balance sheet, out of our total balance sheet size of close to 2.5 lakh crores, we have about 33 to 34,000 crores, which is shareholders' funds. And these shareholders' funds obviously have no accounting cost. There is no interest cost on those shareholders' funds. But they earn the interest rates that are prevalent in the market. So if interest rates come down in the market, then on these treasury investments, we would earn a much lower spread. And because of that, the spread that we would have earned on shareholders' funds, which is the zero-cost money, is about a little over 100 basis points lower than what we would have earned in the previous year, simply because interest rates in the system have come down. But from an operating perspective, spreads have actually widened marginally by 3 basis points compared to what they were in the previous year. Non-performing loan as of 30th of September stood at 0.71%, which compares to 0.69% in June, so it's been a marginal change of around 2 basis points. If we split that 0.71% between the two categories of business, which is individual loans and non-individual loans, individual non-performing loan numbers stood at 53 basis points and non-individual non-performing loan numbers stood at 1.12%. In June of this year, non-individual non-performing loan was 1.06% and individuals was the same, 53 basis points. So there has been a marginal, very marginal increase in the non-individual non-performing loan. But in the aggregate, total non-performing loan is still 71 basis points fully provided for. On a regulatory basis, we require a total provision of 1,797 crores of rupees on 30th of September. This is aggregate provision that we need to carry in the balance sheet. Out of that 1,797 crores, 1,609 crores really is in respect of standard assets, where there is no default, where there is no non-performing loan. It's just that the regulators say that every time we do a loan, we have to debit P&L account upfront by a certain percentage. So that works out to 1,609 crores. And specifically on non-performing loans, we are required to carry a provision of 518 crores. So against a regulatory requirement of carrying a provision of 1,797 crores, we are actually carrying a provision of 2,127 crores. So from a provision perspective, we carry about 330 crores extra compared to what we are required to carry under the law. As you know, we reflect all our investments at historical cost and not at fair value. Now, when we look at our investments, we have both listed investments and unlisted investments. We carry a larger number of non-listed investments and listed investments. So on unlisted investments, it's very difficult to arrive at a market value because there is no transparent market price which you can capture. But if we were to look at the listed investments, there is a transparent stock market valuation that we can calculate, and based on that, the difference between the market price of those investments on 30th of September as compared to the carrying cost, the difference is 58,169 crores of rupees. So we carry unrealized gain of 58,169 crores on listed investments in addition to the unlisted investments. So unlisted would include things like Standard Life, the life insurance business, the general insurance business, and the asset management, and so on and so forth. If you look at the book value per share on a standalone basis, just looking at the shareholders' funds, the way they appear in the balance sheet, the book value per share number would stand at 215 rupees. However, this 215 is not really a correct way to look at it because this 215 rupees a share reflects all or considers all investments at historical cost and not at fair value. So if you were to fair value only the listed investments without giving any cognizance to the unlisted investments, then the adjusted book value per share number would increase from 215 rupees a share to 584 rupees a share. Capital adequacy, and these are capital adequacy numbers prior to the change in the risk weight. The change in the risk weight happened only in the current month, so on 30th September, the risk weight capital adequacy is calculated on the earlier risk weights, which were higher than what they currently are. So capital adequacy, Tier 1 capital stood at, on 30th of September, stood at 12.8%. In addition to that, there is Tier 2 capital of 3.3%, giving us aggregate capital adequacy ratio of 16.1%. But this 16.1% is considered after reducing the investment in HDFC Bank from Tier 1 capital. If instead of reducing it from Tier 1 capital, we were to only treat it as a risk-weighted asset, then the capital adequacy number would increase by about 2.3%. Now, because of the change that has been brought about in the regulations, which is effective October, but it will apply obviously on the entire balance sheet, the reduction in the risk weight increases our Tier 1 capital by about 100 basis points, and it increases our Tier 2 capital by about 30 basis points. So all in all, the reduction in the risk weight will increase our total capital adequacy by 1.3% compared to the numbers that are being reported currently. As was required by regulations, we have created a provision for deferred tax liability on special reserve. In the 6-month period, the deferred tax liability amounts to 172 crores of rupees as compared to 158 crores in the previous year. Now, I continue to state that in our view, we will never be required to pay tax on this liability which is being created. But since it's a regulatory requirement, the deferred tax liability of 172 crores has been provided in the 6-monthly results. The post-tax profit for the quarter stood at 1,605 crores of rupees, which compares to 1,358 crores in the previous year, giving an increase of 18% for the quarter. But as I mentioned earlier, the quarterly numbers includes dividend from HDFC Bank, which was received in this quarter. If you were to look at the 6-month figure, the 6-monthly profit post-tax, post-deferred tax liability stands at 2,966 crores of rupees, which compares to 2,702 crores in the previous year, giving an increase of 10%. If you look at consolidated profits, the life insurance business has had a good 6-month period. The growth has been fairly strong, and because there is a strong growth, there is always the new business strain which gets reflected in the P&L account. So when we take the consolidated profits for the 6-month period stood at 4,082 crores. This is after reducing the charge in respect of the zero coupon bonds. So after reducing that, the profits on a consolidated basis for 6 months is 4,082 crores, which is a 9% increase over the 3,733 crores we had in the previous year. And if we look at the total profits of the subsidiaries as a proportion of the consolidated profits, subsidiaries account now for about 31% of the consolidated profits. So these are broadly what was discussed in the board and broadly the results that we had for the quarter and the half-year period, and be happy to take any questions.
Dividend increase.
Can we do one at a time, please?
Dividend increase, if you could clarify that in the other income. How much was that from the last quarter that was pending? If you can.
So dividend that we have received in this quarter has been higher because HDFC Bank, which gave dividend in the previous year, they had given dividend in the first quarter. This year the dividend has been received in the second quarter. So if you look at the dividend income that we have reflected in the P&L account. If you you asked me, someone asked profit on sale of investments also. So if you look at the profit on sale of investment figure, this quarter the profit on sale of investment figure is a lot lower. It's about 50 crores compared to what we had historically been accounting for on a year-on-year basis. If we look at the dividend income, I don't have the figure readily available here, but dividend income this quarter has been higher compared to what it was in the previous year because of the fact that HDFC Bank dividend was paid in this quarter.
So would you be able to tell us the adjusted PBT and the growth that we have seen minus the capital gains and dividends?
So if we look at the capital gains and the dividend, so if you look at the net interest income figure effectively, the net interest income figure excluding dividend stands at 4,193 crores as compared to 3,768 crores in the previous year, giving an increase of 11%.
That is 6 months.
That is 6 months. And if you look at the quarter, okay.
Anyways,
Also, could you clarify NII? Just
So I
we have
explained to you there are different
yeah.
ways in which NII is calculated.
Yours.
So if you take NII for the with dividend, then in the 6-month period, for example, NII is up 12%. In the quarter, NII is up 21% because of the dividend.
The figure.
If we exclude the dividend, then the NII in the quarter is up 6%, and the NII in the 6-month period is up 11%. So the NII then for the quarter is 2,076 crores.
what is the growth figure if you exclude the dividend? Is that a number that is possible to give us?
Yeah, so if you look at the dividend income, if you remove roughly about 400 odd crores for the dividend income, then you will get the growth figure. The growth figure then in the profits would be roughly about 7 to 8% in the quarter, which is effectively what you will see in the net interest income without dividend.
And also you have seen a little bit of expansion when it comes to the spreads. Now,
No, we have seen an expansion in spreads, but a reduction in net interest margin, which I explained that spreads are higher because of utilization, investment of shareholders' funds, which effectively will get you the interest rate that is prevalent in the system.
what I wanted to understand, Mr. Mistry, is that how much is your average funding cost coming to? Because you have a large amount of it coming from wholesale, so your rate would be much lower than what banks would be paying at this point. And on the other hand, do you have more headroom for reducing your home loan rates further, considering your spread?
So it is something which we keep reviewing on a regular basis. Whenever we feel that there has been sufficient reduction in cost of funds, we will of course go and reduce our lending rates. We would obviously prefer to pass on the benefit back to customers. See, ultimately it is reflected in spreads. So as long as spreads are in that band of 2.29, which is where they were last year, and 2.32, which is where they are now, there's really never not been a significant expansion in spreads. But when we start seeing that, because incremental costs comes in lower, at that stage we will of course look at lending rates.
Of course, you keep raising money as normal business activity, but this 750 million that you may look to raise in the near course of future, you've already raised some substantial amount recently through your NCDs and warrants. Any specific reason that you're also looking to do this?
It's just a diversification of funding sources for us. So in the past, it was not possible for Indian companies to issue rupee-denominated bonds. So a rupee-denominated bond means the bond is issued in Indian rupees. It is denominated in Indian rupees. The exchange risk on that bond is taken by the overseas investor. So the overseas investor subscribes to a rupee bond, and the exchange risk is taken by them. So it's not been done in the Indian market. I think IFC had done something some time back, but other than that, no Indian company, to the best of my knowledge, has done it, because there are still a couple of items which need to be clarified on taxation, withholding tax, and so on and so forth, which it is widely expected will get cleared over the next few days.
So the
What
reason...
really for affordable housing, that is something that you have really done last time. Are
That's right.
you to look at that?
So that is something we did we did raise money for under the affordable housing window, and we will continue to look at that in future. It's just that there is an overall limit of $1 billion for the year. So for this year, that limit has been exhausted. Once the new limit opens up, we will of course want to go and raise. For us, money is raw material, so we keep needing money on a continuous basis.
And HDFC Bank has been, at its press conference, indicated that they've been increasing the amount of loans that they're buying
That's
back.
right.
If they start buying by actually up to the 70% of the contract.
Okay, so let me explain to you. The arrangement we have at HDFC Bank is that they don't do housing loans themselves. They source loans for us. They bring application forms from potential customers to our office. We do the credit checks, the legal checks, the technical checks. We decide whether to lend money to a particular customer or not. If we decide to lend money, we make the disbursement to the customer, and then the agreement that we have with the bank is that they have a right, if they wish, to buy a certain percentage of those loans. Now, if they want to buy priority sector loans, then they can buy up to 55% of the loans that they have sourced. If they buy non-priority sector loans, then they can buy up to 70% of the loans that they've sourced. Now, till last year, they were buying priority sector loans, and therefore their purchase of loans was restricted to 55% of what they sourced. This year, they've sought to buy non-priority sector loans, and therefore their quantum of loans sold has been higher. So as I mentioned earlier, in the last 12 months, we've sold loans aggregating to 12,969 crores of rupees.
How does it, Mr.
Yeah.
Mistry,
So if I can I explain that? Yeah. When we sell a loan, we don't book profits up front. the way you would be required to do under IFRS or the way you'd be required to do under US GAAP. So let's assume that the underlying interest rate on a loan that we are given to a customer is, for argument's sake, let's say 9.8%, for argument's sake. And let us, for argument's sake, say that the loan has been sold at, say, 1.25% lower. So if the loan has been sold, let's say, at 8.55%, the customer will continue to pay, in this example, 9.8% to us. Of that 9.8%, in this example, we will retain 1.25% as our income and pay the balance amount to whoever we have sold the loans to. So that then creates a stream of income for future years. So we earn income not just on loans which are appearing in the balance sheet, we also earn income on loans which have been sold by us. So I think I mentioned earlier that on 30th of September, we had a total of 29,125 crores of loans which have been sold by us, on which we earn a weighted average return of 1.22%.
And how is it going to impact your loan growth?
So it depends on how you look at loan growth. If you look at loan growth net of the sale of loans, then obviously the loan book growth gets impacted. But if you look at the sale, if you add back the loans sold in the last 12 months, then it does not get impacted. From a pure return on equity perspective, this is great business, because when we sell a loan, there is no capital that we need to provide in respect of that loans, but we continue to receive income. So it enhances the return on equity without in any way resulting in us taking on any risk, because once the loan is sold, there is no risk that is attached to the balance sheet, and secondly, we don't have to provide any capital. So therefore, from an ROE perspective, it is very good.
You said you were looking for an HDFC Life IPO in 2016, and prior to that you needed to take some regulatory approvals. How far is that process?
So what we did was we made an announcement in August where we said that Standard Life had the option to buy a certain percentage of the shares of HDFC. They had the option to go up to 49%. They have decided not to go up to 49%, to give up some of the option. So they will ultimately go only to 35%. So currently their shareholding is 26%. They will buy 9% of shares from us. For that 9%, the application has recently been made to FIPB. Once that, and IRDA has recently come out with some changes that are required in the shareholders agreement. That is currently being worked on. My sense is once this transaction is completed, then we will look to file for an IPO. So therefore the IPO will not happen in 2015 for sure, but 2016 is when we explained last time also as being the possible date when an IPO would happen, somewhere in the middle of 2016.
And you will dilute 10% stake to begin with?
That is something which we will take a call on at that point of time. The law requires, or SEBI requires, 25% of the shares of a company to be listed. Whether we should do 25 in one go or we should do 25 in a phased manner is a call we will take as we get closer to the date of the IPO.
Mr. Mistry, a few figures on your results. Loans growth in this quarter, net loan growth would stand at.
So if we look at the loan book growth, again adding back the loans that we sold in the last 12 months, then my sense is the growth would have been about 22% in retail loans.
And balance sheet.
So if we look at the incremental, if we take 31st March and if we take 30th June, and we look at the difference, the growth and how the growth has come, how much has come on individual loans, how much has come on non-individual loans, then almost the entire growth has come on individual loans. So 101% of the increase in the loan book in this first 6 months has come on individual loans. This also partly reflects our feel that we want to be a little more cautious on the non-individual front or non-individual loans in this kind of an environment. But hopefully as the investment cycle in India picks up, and my sense is it's a matter of time before it does, once the investment cycle picks up, because that base has not been growing at as rapid a pace as the individual business has been growing, my sense is the growth numbers could be a lot higher going forward.
HDFC Bank only sources individual home loans.
That's correct. HDFC Bank sources only individual home loans. Now the other important thing which you should know is that a very large proportion of the loans that we do to individuals is sourced through distribution partners. So there is HDFC Bank, there is HDFC Sales, which is a 100% subsidiary of ours. There are other distribution partners like we have IndusInd Bank, we have Ratnakar Bank, we have a few other finance companies. To all these people who source loans for us, their job is to collect an application form from a potential customer and get it to our office. We do all the legal credit checks, and therefore in terms of quality, there is no difference in quality between a loan given to a customer who has come through one of these distribution partners as opposed to someone who has come directly to our office. But we pay the distribution partner a fee or a commission for getting business for us, and whilst under IFRS we'd be required to amortize that cost over the life of the loan, we do not do that. We have historically been charging that cost upfront to the P&L account. So therefore accounting profits will always grow at a lower pace when individual business grows faster because of the way we do accounting. If we amortize that cost, the fees that we'd have paid in this 6-month period would be a little over 200 crores, about 210 odd crores. So if those fees were amortized over the life of the loan, then naturally the accounting profits would go higher, but we've historically just charged it upfront, and therefore we continue to charge it upfront.
So what's the time frame by which you require $750 million if you do it? I'm sure you...
See, we have no time frame in mind. We have to take various decisions. We have only taken an in-principle approval from the board because the law requires an in-principle approval from the board. So we've taken that approval. We will now look a little more into details on whether we should do a issue in the Reg S market or a 144A issue, whether it should be rated, unrated. So all those decisions we will take over the next 2-3 months. There are 1 or 2 clarifications that are required. Withholding tax is one such clarification. We understand that the current withholding tax requirement for an instrument like this is high, but there is very widespread expectation that that will be reduced soon, and that clarification is expected to come in the near future. So we'll obviously wait for that clarification.
So the rate curve is shifting downwards. Definitely it's not going to go up, and this may remain stable. So what's your sense on your NIMs going forward?
See, when we talk of spread,
Keki Mistry there talking about the nitty-gritties of the number, how Standard Life is also going to hike stake to 35% from the current 26%. They're talking about the life insurance IPO. That's something that's been much awaited by the management of HDFC in terms of a timeline. Well, the middle of next year. They've also sought the FIPB not to sell about 9% stake in HDFC Life. And you had some other comments as well coming in from the management talking a little bit about the earnings, how the earnings have been. The stock down by 1.5%, but on that note, we wrap it up on the show. Stay tuned for closing trades. Lots of market action lined up.